Hello everyone, my name's Harry Thompson, and today this presentation will take you through what's been driving portfolio returns, with a specific focus on AI and how we are keeping diversified. It is reported that AI stocks now account for roughly 44% of the S&P 500 market cap. This includes hyperscalers and cloud service providers, as well as a range of other companies, from chip manufacturers to application developers, as well as network, storage and cooling systems. Since the turn of the year, markets have become increasingly volatile, driven by AI disruption fears, with several sectors in the crosshairs following the release of more sophisticated tools by the US company Anthropic. In particular, software stocks have felt the brunt of it, as fears grow that AI could in effect replace much of what these companies have traditionally done. More broadly, this wave of pressure has led to markets to question the impact of AI in many sectors. Other sectors of note that felt the effects of this were wealth management and logistics. We think it's been telling that in many areas there has not been a so-called buy the dip wave. Instead, investors are seeking companies that expose them to the picks and shovels of AI infrastructure build-out, given the significant spending plans made by large tech names or hyperscalers, and to sectors that will benefit from the application of AI, rather than risk being displaced by it. We've been analysing these stocks which are highly correlated to the AI narrative, and we've been managing exposure, adding to exposure that has a low correlation such as water and waste and emerging markets. The infrastructure build-out related to AI has created a number of investment opportunities. Whilst the market has become increasingly sceptical of the expected returns from the level of investment from big tech names such as Microsoft, portfolios have benefited from the so-called picks and shovels makers, who have seen a growth in demand for their products related to grid upgrades and energy demand for data centres. This includes names such as Schneider Electric, who provide critical data centre infrastructure, including power, cooling, security, IT deployment, prefabricated modules, UPS systems and monitoring software. Data centres underpin much of its energy management division, which drives growth and contributes roughly 25% of total revenue. Competitors like ABB and Siemens offer similar services, but data centres represent a smaller share of their revenue. Other beneficiaries include Tran Technologies, whose air cooling systems are essential for data centres, alongside broader climate products such as heat pumps and energy storage. Quanta Services focuses on energy infrastructure, including transmission lines, renewables and grid connectivity. Rising energy demand and data centre expansion has significantly boosted its exposure, with a record order backlog reported, driven by the data centre boom. Semiconductors have also been flying high on AI demand, including Taiwan Semiconductor, but also names such as Nvidia and ASML. Energy efficiency has played a major role in keeping power demand subdued, but now data centres are a major force in the rising demand for electricity. This rapid expansion has reshaped energy systems due to the huge power demand required to feed these energy-hungry operations, with data centre energy demand growing by over 400% in the last 10 years. Not only are numbers rising dramatically, the size of the projects and their data needs are jumping as well. To put this into perspective, it's reported that a single ChatGPT query can require nearly 10 times more electricity than a Google search. This is feeding through to high electricity prices, which has raised policymakers' concerns given the focus on energy affordability at the moment. In recent months, this has led to a number of US states to consider pausing new data centre build-outs in order to consider the resiliency of the grid. One of the major concerns is the impact the data centres are having on the local environment and community, given they provide more limited benefits. Donald Trump has been vocal in a push for tech firms to pay for this power rise. Whilst we are not there yet, in extreme situations there could be energy rationing or regulation to protect energy systems, which too could impact some of the growth expectations for AI. Renewable energy has been a strong beneficiary of the AI infrastructure build-out, given the focus on bringing more energy sources online. Existing or repowered fossil fuel plants are able to meet near-term needs, but renewable energy will meet higher demand as utilities seek sustainable long-term energy sources. Renewables such as solar are able to come online in a quicker time frame than gas turbines or nuclear power plants, with the latter taking up to 10 to 15 years to plan and commission. Leading names such as Vestas, who manufacture wind turbines, and First Solar, who manufacture solar panels, have had a strong 6 to 12 months. The data center operators are seeking huge amounts of energy to power their centers, and there is a big focus on low carbon, so nuclear has also benefited as a result. These returns, amongst others, have helped drive the clean energy sector higher, as detailed on this slide. Renewable energy is expanding rapidly, with the International Energy Agency expecting capacity to more than double by 2030, significantly reducing CO2 emissions. While AI has driven near-term electricity demand, long-term growth is led by industry and transport electrification, reinforcing the need for grid modernisation and keeping the decarbonisation theme intact. China is the world's largest clean energy developer, now holding more renewable capacity than fossil fuels, and accounting for around 60% of new global renewable installations. It reached its 2035 wind and solar targets 5 years early, though profitability has suffered due to oversupply and heavy price discounting. This issue is most evident in solar, where Chinese overcapacity and subsidies have flooded global markets, pressuring margins for international and domestic producers. While this poses risks, portfolio's exposure to solar has been limited, and from a broader climate perspective, excess Chinese capacity, particularly in solar and batteries, is helping developing countries accelerate green energy adoption. In the face of AI concerns, we'll now look at some of the sectors we're allocating to remain diversified. Water and waste being the first. We're able to gain exposure to water and waste through direct funds, but also more general environmental focused funds. It's a sector we increased exposure to in Q4 last year, given our preference to increase defensive exposure through the likes of utilities. We identified the sector to have a low correlation to AI, which was another reason for increasing exposure. Water use is an increasing AI concern as data centers and semiconductor fabs require continuous high-quality water supply. With the geographic concentration of semi-manufacturers in Taiwan, South Korea and parts of the US, there are single point of failure risks, so companies managing these ESG risks, such as TSMC, are seen as better positioned than others. The physical element of water, waste and environmental adaptation reduces disruption and replacement risks from the growth of AI. As some sectors have been sold off dramatically, investors have looked for so-called halo stocks, those with heavy assets with low obsolescence, meaning they're unlikely to become outdated or disrupted, meaning they're more resilient to technological or market changes. Areas such as energy, commodities, utilities and consumer staples are sectors in this bucket, alongside many of the names within water and waste. Whilst the theme provides low correlations to AI, many of the companies within it are expected to benefit from the increased adoption. Monitoring, predicted analytics and real-time data flows are all important aspects of their solutions, which can be optimized by AI to function alongside the physical elements. Ecolab, for example, have developed an intelligence platform which uses AI-powered predictive analytics and real-time data to support customers in optimizing water usage, which inherently helps businesses improve their water usage efficiency and therefore minimize water waste. Another key area of diversification has been our EM exposure. Since Trump's Liberation Day in April last year, there has been a shift in capital allocations as investors look to diversify. Alongside other Trump-related concerns such as Fed independence, the US dollar has weakened significantly. European equities and emerging markets have been both beneficiaries of these flows, most notably the latter in particular benefiting from the weak US dollar and more settled fiscal policy from EM central banks. Emerging markets outperformed developed markets in 2025 after more than a decade of underperformance, driven by attractive valuations and strong earnings potential alongside the currency and diversification benefits. And finally, healthcare. The sentiment towards the sector did improve in 2025, with notable events including large pharma drug pricing agreements with the US. Policy risks do remain, as seen with the announcement of lower Medicare reimbursements and a lack of progress with US health insurance coverage from the Affordable Care Act. Whilst healthcare returns have been more subdued in recent months, the sector has outperformed global equities over the last 6 months. There's been a notable pickup in M&A activity as large companies seek to boost their product pipeline. We favour a large focus on defensive properties of pharmaceuticals, with a partial allocation to biotech and the prospect of higher returns from drug pricing and the continued M&A. And that concludes our brief update. A larger text version is available. Model portfolios were also rebalanced at the start of February, whilst investment committee minutes were sent round. If you haven't received them, please contact us. Thank you for listening.